Welcome back to the Charting Reflection Podcast, the space where we sharpen our edge by sharpening our thinking. I'm Hector, and today we're tackling a topic that quietly drives most of your decisions on the chart: directional beliefs, what many call directional bias. Quick definition before we dive in. A directional belief is your working view about where price is likely to travel, up, down, or sideways. You can also hold an agnostic stance. I don't have enough evidence yet. That's not weakness, it's discipline. 1. Markets are dynamic, so your beliefs must be too. The market changes character. A clean uptrend morphs into a range morphs into a breakdown, and then back again. Because the market is dynamic, legitimate analysts will sometimes lean bullish, and at other times lean bearish. That isn't flip-flopping, that's updating. Beware the pundit trick. It could go up or down with no conditions, no time frames, and no invalidation. That's not analysis, it's a horoscope. Serious traders speak in conditionals, they say. If the weekly closes above X and holds a higher low, I'll lean long. If we close back below Y with momentum, I'll lean short. That's not being vague. That's scenario planning, and it's how you map action to evidence. 2. Directional beliefs are probabilistic, not promises. When we say, I'm leaning up, we're not saying price must go up. We're saying, given the evidence, it's more likely to go up until proven otherwise. The moment new information lowers that probability, we update. Certainty is a liability in trading. Probability is the game. Replace statements like, this is definitely bullish, with, this currently favors the long side. Words matter because they shape your behavior. 3. Opinion versus technical argument. Let's separate two things that often get mixed. Opinion: a hunch, a feeling, an intuition, a macro belief, or a trust me, bro. Opinions can be useful as starting points. Just label them honestly. Technical argument: evidence anchored in price, structure, levels, order flow, volume, liquidity pools, higher time frame closes, failed breakouts, acceptance versus rejection. On a chart, a technical argument sounds like this: we broke structure to the upside, reclaimed last week's high, and accepted above it on volume. Until we lose that level and print a lower low, long remains the higher probability path. That's clear, falsifiable, and tradable. 4. Field-specific versus time-specific beliefs. Some beliefs come from the field you're in: fundamentals, narratives, or long-term conviction. Example: I believe in Bitcoin long-term because of X reasons. Totally fine. That's field-specific. But your trades live on time. Time-specific beliefs come from technicals on defined time frames. Weekly structure, higher time frame context, daily close reclaiming a key level, swing signal, 1-hour deviation or liquidity sweep, execution detail. You can hold a long-term bullish conviction on an asset and take short setups on the way because the time-specific evidence tells you the path of least resistance, here and now, is down. That's not contradiction, that's coherence across time frames. 5. Semantics matter. Don't marry a side. Saying I'm bullish or I'm bearish can glue you to an identity. Identity sticks. Trades need to change. Instead say, I'm long-leaning until X invalidates. I'm short-leaning unless we reclaim Y with acceptance. I'm agnostic between these levels. Your belief must serve a purpose: to buy or sell with intent, not to be right on the internet. When your belief becomes personal, you start defending it against the chart, and that's when you ignore evidence, overstay trades, and get triggered by any opposing view. We don't trade to protect our ego. We trade to express intentionality under uncertainty. 6. a simple framework for building directional beliefs. Here's a practical, repeatable process you can paste into your playbook. A. Define context. Higher time frame first. What's the weekly structure? Higher highs, higher lows, or lower highs, lower lows? Are we trending or ranging? Where are the obvious magnets? Prior highs, lows, imbalance zones, liquidity clusters, session VWAPs, weekly opens. B. Identify your decision levels. Mark the line as in the sand, the exact levels where acceptance or rejection changes your belief. Example: above 123,000 weekly close equals bullish continuation favored. Below 113,000 weekly close equals sustained downside favored. Inside equals range/agnostic. C. Write two conditional scenarios. Long-leaning scenario. What must happen? Who is trapped if it happens? Where is your invalidation? Short-leaning scenario. Same questions, mirrored. If neither set of conditions prints, your stance is agnostic. No shame. Flat is a position. D. Attach timeframes and triggers. HTF gives the bias. LTF gives the entry. Triggers can be reclaim after a sweep, market structure shift on the first half, acceptance above, below a level, or a failed breakout into a quick reversal. E. Pre-mortem and invalidation. Ask, if I'm wrong, how will it look early? Put your hard stop where your thesis is truly invalid, not where it merely hurts. F. Execute with intent. Position size follows probability and clarity, not hope. If the market proves you wrong, flip or flatten without drama. The chart isn't attacking you, it's updating you. 7. The agnostic stance is a weapon, not a weakness. Most forced losses come from feeling obligated to have a view. You are not a broadcast channel, you are a risk manager. When the picture is muddy, overlapping ranges, mixed signals, no acceptance, choose neutrality. Preserve mental capital. Great traders are selective. They let the market do something clear, and then they act hard. 8. Common traps to avoid. The two-way guru calls both directions with no conditions, demand time, level, and invalidation. Perma identity. The always bullish or always bearish persona. Fun for engagement. Terrible for P and L. Narrative override. Letting a macro story drown out what price is actually doing today. Wick chasing. Reading a single candle without context. A bullish candle under major resistance can be a trap. Late belief updates. Refusing to pivot after invalidation. Your first loss is your best loss. 9. A worked example. Structure plus, levels plus conditions. Let's imagine an asset trading between 113,000 and 123,000 after a strong run. Context: weekly uptrend, but we've been ranging for 2 weeks. Liquidity sits above 123,000 highs and below 113,000 lows. Decision levels: bullish case. Weekly acceptance above 123,000, followed by a higher low on the daily above that level. Long leaning until we lose the reclaim. Invalidation: lose 123,000 and print a daily lower low back inside the range. Bearish case: weekly, close back below 113,000 with follow-through. Not a wick, actual acceptance, plus a lower high on the daily. Short leaning unless we reclaim 113,000 and hold. Inside the box. Agnostic. Range tactics only. Take partials quickly and respect both edges. Notice how each case is conditional, time-bound, and falsifiable. That's a directional belief you can trade, not a slogan you can tweet. 10. Build your language and your discipline. Starting today, rewrite your internal script. From I'm bullish to I'm long leaning on the weekly until we lose X. If we do, I pivot. From I think it dumps to below Y with acceptance and a lower high, the short side is favored. This language protects you from ego attachment and keeps you focused on actionable if-then rules. 11. A 3-line exercise for your next session. Before you trade, write these 3 lines. Context. HTF is nuajiak. We are trending, ranging. Key magnets. If long, then I'll lean long if wire on time frame. Aux. Invalidation. Aug. If short, then I'll lean short if as on time frame as. Invalidation. I. If neither condition prints, you are agnostic and you do nothing. That restraint is part of your edge. 12. Final thoughts. Directional beliefs are tools, not titles. They serve your intentionality. When to engage, where to risk, and how to exit. Build them from evidence, state them conditionally, and detach your identity from the outcome. Update quickly, execute cleanly, and let the market tell you when your belief has expired. If today's episode helped clarify your thinking, share it with a trader who needs fewer slogans and more structure. Thanks for tuning in to the Charting Reflection podcast. Follow me on X and join the free Telegram for setups and live insights. Links are in the description. Until next time, stay focused, stay patient, and trade with intent.